Hi, it's Pete Kroll, and we are back for part 2 of our interview with Garvin Jabusch. This is Dollars and Change, the expert's guide to sustainable and responsible investing. And we are back here in beautiful downtown Niwot, Colorado. Just how did you describe it earlier?
Norman Rockwell.
Norman Rockwell of Colorado here, which is north of Boulder. And so we talked in the previous episode. We got a little background on you, and if you haven't watched the previous episode, why don't you make sure that you do, because you can get some background on my good friend Garvin here. But we talked a little bit about the genesis of Green Alpha, and we talked a little bit about sort of your journey to becoming a true expert in sustainable investing in the next economy, and which is really what we're going to talk a little bit about during this episode. So
cool. Now we're getting into the weeds.
We're getting into the weeds.
Fun
this is
stuff.
where we're going to make people upset, and I'm looking forward to it. So
this is where Pete and I intensely agree on everything.
Absolutely.
So if you're looking for a little bit of conflict for your pod, you may not find it right now.
Yeah, we're not going to find it right now.
I don't know what we'll disagree on. We can try.
We can try is right. So next economy. Let's just start right there. What's the definition? You in the last episode you talked a little bit about where it came from, but let's start from scratch here.
Sure. So we realized at some point that if the goal is to have a technological economy and civilization that is planetarily harmonic, that being the goal with technology, ideally,
right?
That economy is going to need to have certain characteristics in order to avoid the system level risks, which can be defined any number of ways. I know one common framing of them is the planetary boundaries,
right?
System level risks through which we can't crash and still have a good economy.
And there's been more and more understanding of planetary boundaries as scientists understand more and more about ecosystem services and so many other areas.
So much interesting work, and those get updated and refined all the time, and I think for the better all the time. Mostly we have a better understanding of the massive complexities involved, which ends up being scary because we learn that small perturbations actually end up having big effects.
Absolutely.
And further downstream you get, the bigger the effects are, of course.
Butterfly effect.
Among
other things. Yeah.
So in our sort of simplified economics model way of putting it, which we do sort of for our pitch deck and for marketing purposes, to try to encapsulate it in a way that's relatively, it still isn't the simplest thing in the world to get your head around, but is much simpler than trying to assimilate the entire model of an economy that can thrive indefinitely, again, without crashing into the system level risks. We define the next economy as resting upon 4 pillars.
Okay.
That will permit us to diffuse many, if ideally not all, of the system level risks that are most looming, right? So first, we think that economy needs to be, and I can go as far in the weeds as you like on this,
okay,
based on largely on the work of E.O. Wilson and his island geography concepts. If you blow that up to its largest extent, you can think of the Earth itself as an island. And so pillar number 1. The economy has to be characterized by ever-increasing productivity gains, meaning more output out of fewer inputs. That just almost should be self-explanatory, right? But we need to be getting so much economic output versus so few inputs that everyone on Earth can have a good standard of living without crushing the underlying biosphere.
Right.
It's pretty much as simple as that. And that needs to be ongoing. It can never stop.
Yeah, because we're headed towards 10 billion people.
Yeah, and eventually we may reach a point where that plateaus and start shrinking again. I know there are some economists worried about that right now.
Likely,
but even at 4 billion at a given level of rapaciousness, it's still too much for Earth to tolerate, right? So we need the economy to be ever more productive. Now, from a stock picker point of view, this is coincidentally happy because it also equals wealth generation, right? So not only can it reduce our overall footprint on Earth, diminish our prospects of crashing through planetary boundaries, but also generate wealth along the way, which is, as stock pickers, what guys like you and me want.
Yeah.
Right?
And it creates wealth through innovation.
That's exactly right.
Yep.
So that's the first pillar. Never ceasing, radically improving economic efficiencies. productivity efficiency gains,
Yep.
right? Second is all these awesome new means of production have to be powered by true renewable energies. They kind of go together, right? Because renewables are so much more economically productive than fossils that they're part of the same overall picture, but breaking them out separately really helps us get a clear picture of why we need to be based on renewables as opposed to non-renewables.
And it moves it to the forefront. At the end of the day, we need to be generating power from the sun up there, not necessarily from dinosaurs that lived, millions of years ago.
Yeah, yeah. And by not necessarily mean absolutely not.
Yes.
Yeah.
Absolutely not.
Yeah. So that's an extremely important part of it, but it also aids in productivity gains, right? If your energy literally falls from the sky as opposed to being dredged up out of the earth, you're getting the same beneficial use of the electricity to make stuff and run things like AI and whatever, but you're getting it on the basis of a free input. This is the definition of a productivity gain.
Yeah, once that solar panel is made, for the most part, you've got at least 20 plus years that you're going to be able to use that resource. Same thing with a windmill or geothermal for that matter as well. Yeah.
Yeah, and that actually brings me to an important definition that we use here. For us, a true renewable energy source is one that has zero cost of fuel. Right.
There you go.
So some folks we can have the debate about nuclear if you like, or the discussion about nuclear, but there's a cost of fuel there.
Sure,
and then
there is.
there's a cost of disposing of the spent fuel.
Yep.
And so for us, that's not a true renewable. A true renewable has zero cost of fuel. Why is that important? Doesn't come with externalities, one. And two, it's important because that is a much greater, again, economic productivity gain.
Yep.
Beneficial energetic output on the basis of no input.
Period.
It's as productive as it gets.
Yep.
Like that's the ne plus ultra of productivity. Okay, then the third pillar is ideally we have to get the economy into a closed loop wasted value supply chain, meaning we quit hammering on the earth for primary geological resources as much. The earth can indefinitely sustain some of that, but not as much as we're doing now, right? So we have to, again, this goes back to pillar one. We have to get more out of less.
Right.
And then finally.
I mean, a lot of people, I was just going to say that's the basis of circular economy, right?
Yeah.
The idea that, we have got a ton of resources that are in this phone right now. And, in so many ways, unless you're reusing this over and over and over again, which we ultimately can, it's just a wasteful economy. It goes back to, Bill McDonough, who was sort of the foundation for me starting Crown Company and then Earth Equity, writing Cradle to Cradle. That's always sort of been at the base of what we've tried to do as well. Yeah, and he was definitely seminal in our thinking too. Jeremy and I met him early on because he came to Forward Funds because he was involved in a startup and he wanted to pitch Forward on potentially doing a seed round for them. Yeah, it was hilarious because it was actually about improving, because this is before EVs. So it was a startup that was, I don't believe it ever did much, or if it did, I wasn't aware of it. Sorry, Bill, if you watch this. But it was about radically improving the MPG efficiency of ICEs. Okay. Because this was before EVs were on the horizon. And so as far as it went, it wasn't a bad idea for its time. But so he gave us all copies of Cradle to Cradle. It was cool. It was on recycled paper and all that. Yeah, I've got a signed copy of it as well. Yeah. So that thinking was absolutely essential for us. So all these things kind of go together. You can think of them as a piece, but never-ending productivity gains, all powered by renewable energies and supplied by a wasted value supply chain. Boom. Right? Yep. These are key things. Like, to me, this is sort of obvious. If you want to have an economy that works indefinitely and takes care of everyone without crashing into planetary risks, this is how it has to look. Yep. Right? And then finally, our fourth pillar is there has to be better equality of opportunity. Like, wealth, not necessarily income, but wealth has to be more fairly distributed, or at least have the opportunity to be more fairly distributed. Why? Because dramatic inequality itself is a system-level risk. Right. History. Oh, it's a huge risk. History and prehistory even prove that the only thing that ever reverses incredibly sharp, dramatic inequality is violence, upheaval, revolution. Yeah. Pandemics can do it. But there's never been a period of very extreme inequality that wasn't resolved by some very unfortunate resolution. And it would seem to me that of the four pillars, that's the hardest one to put into action. It is. In an investment perspective.
Yeah, yeah. The other three you can invest in directly.
Right.
So the fourth one is definitely the softest one we use criteria wise. Like, so we will maybe like we won't include or exclude a company on this basis, but we might turn up the weight of a company a little bit if they are doing things such as making share ownership available to all the employees. We're not the biggest fan of buybacks overall, but where they do exist, we love it where what they exist to do is fund the employee stock ownership plan.
Okay.
Right? Things like that. So again, a company isn't going to standard fall in the portfolio on the basis of whether they do that. But if they are doing that, we might say, wow, instead of 1%, maybe they need 1.25% weight.
Right.
They like their employees are going to be more invested. They're doing something about wealth disparity in the world, a little something anyway.
Yeah.
So and then there are less direct ways that are further downstream to think about it. Like some forms of technology are by themselves levelizing. And others are the opposite, though.
Right.
They can result in more inequality. And some, we don't know the outcome yet because it's too soon, such as AI.
Yep, exactly. So let's take Next Economy a step further, and so let's talk about some of the things that some of the sectors and industries that you really see. Obviously, clean energy is a no-brainer. But what are some of the other kinds of sectors? I know you and I are both strong believers that biotech is a next economy, a sustainable kind of company. I'm of the belief that a healthier society is a more sustainable society. That makes sense to me. Let's talk about biotech and some other areas.
Yeah, a place where we violently agree. Biotech is the future. I think it's going to be the basis of the next industrial revolution, particularly as it confluences with AI.
Oh, yes, absolutely.
The two together, they almost have to go together.
Yep.
The most important advances in biotech can't happen without the computational abilities of AI. But you're right.
Dive into that just a little bit.
Okay,
Yeah.
I'll come around to that.
Yeah.
But you're right in that you kind of started going here. Human disease burden is a horrible drain on global GDP.
Right.
And addressing that will do a lot to help the economy thrive without making it less sustainable. But that's only the tip of the iceberg with biotech. There's also all kinds of regenerative agriculture applications. There's material science applications. There's even transportation applications. And then there's any number of applications which we can't foresee yet, but which are going to be a big deal.
Yep.
They're only going to be possible. How come? Because of innovation.
Right.
Right? So the first, and just seminally, is Jennifer Doudna and Emmanuel Charpentier's discovery of CRISPR-Cas9 gene editing in 2012. That's only been 12 years ago, and we already have therapeutics in the clinic based on it.
Yes.
Which is amazing. Sickle cell has been effectively remediated for anyone who can afford it so far, which is crazy, unthinkable not very long ago.
And for those of you who don't know what CRISPR is, it basically is gene editing. It's going in. It was a technique that they found where they can look at a DNA strand and very accurately clip here, pull out, and reinsert a different chain right there that fixes what was the problem before.
Yep, or modifies something to optimize it for a certain condition, like such as making crops salt tolerant or drought tolerant or higher in nutrients.
Yep.
And so one of the other places we look for portfolio exposure are companies that are continuing to advance the forefront of that. The initial discovery 12 years ago was one thing, but now there's all kinds of companies. We're currently deep into the research process on one called Metagenome that is advancing a toolkit to bring all kinds of disparate and different ways of bringing gene editing into the forefront of not only research but applications.
That's cool.
Super cool stuff. That process is never going to stop. It's part of Pillar 1, never ceasing productivity gains.
Yeah.
So as gene editing gets more and more precise and better and faster, all aided by AI, which we still need to dive a little deeper into that. It's just going to get more and more interesting and solve more and more problems. Like, think about replacing petrochemicals with biopolymers, right? This is this is a way to get plastics out of our environment.
And it's going to happen. This isn't something that is, theoretical. This is something that is going to happen. It's just a matter of when we're able to scale it.
That's right.
At the end of the day.
Yep, and being invested in it early is a very interesting way to earn alpha over time.
Absolutely. And that's something that I've actually had conversations with people recently quite a bit is, for so long investing was long term. It was investing in a business. It was investing in building a business.
Mm-hmm. Like private equity.
Exactly. But with the genesis of the internet and so many things that have made information so fast, we're looking now at like weekly sales figures for companies and stuff like that isn't about building a long-term business. It's about speculating on short-term profitability. And my definition of my definition of growth investing is sustainable investing. They are tied together because we're investing in where the economy is going.
100%.
And talking about bioplastics and things like this, or they're not there yet, but they are going to be there, and we want to be invested in the market leaders before they're the market leaders.
You got to be at the forefront.
Yeah.
If like Jeremy always says, indexing is like active investing, just extremely slow.
Absolutely, and that's one of my favorite phrases because you're late to the party every time.
So if you can identify, in this case, the biotech leaders that own the intellectual property for how to accomplish things and how to make the next innovation, it's a pretty relatively, if you own a decent basket of those, you've got a basket of relatively high percentage bets. You don't need them all to win, right? But you need enough of them too that whatever gains you earn are going to more than outweigh any losses you incur on the ones that, because you're early, didn't end up working out. But if you look for the ones that are the IP leaders that have a very defensible moat, you've got a really good shot of having more winners than losers in there by the time they've made it to the public markets, right? And so getting those before the mainstream world realizes it and puts them in the index means you've earned all the alpha. By the time it's in the index, a lot of the upsides has been done. And
a lot of them are probably going to get acquired at some point as well too. So you're looking for the upside on that as well.
Yeah, on the real leaders, there's not as much upside in the acquisition as in the organic growth, but still, we'll take the upside as it comes.
Absolutely.
But a good example of that would be Moderna.
You own Moderna really early.
Really early. We put it in the portfolios in early 2019 at a time when they were still a pre-earnings biotech.
Right.
And we were told we were crazy by a lot of people, but the thesis we were just talking about is why we did it.
Yeah.
They owned the big chunk of IP for how to modify messenger RNA such that you can make a phenotypic change in an organism such that it could resist disease. Well, my thesis then, at that time, was, okay, they're pre-earnings, so like a quant or, would never buy it.
Right.
Or a value person would never buy it. But I just thought, geez, the worst outcome for this stock is going to be that somebody's going to buy it just so they can own that IP.
Right.
And then, the catalyst of the pandemic occurred and it blew up for us. And then, guess what? It got added to an index and then the whole world started buying it. Well, we already had a ton of exposure long before that. I think we got 100 bagger out of that one.
And now they're looking to have a vaccine for cancer. I mean, they're not stopping with just what they with the with the pandemic, with COVID vaccines. They actually are moving forward with something that they've now proven works.
And that brings up an example that we could use to illustrate your question about integrating AI with biotech. And if you hear Stephen Bonsell talk, the CEO of Moderna, you'll hear him say that most of their big advances wouldn't have been possible without AI, including the possibility of treating cancer. So one of the ways that they're attempting to do that in a greatly simplified, non-specialist kind of way is on the basis of each individual cancer. Cancer is notoriously tough at resisting immune therapies. Mm-hmm. It's found multiple ways to do little handshakes with your immune system such that it doesn't necessarily recognize it as something foreign or bad that your immune system has to kill. Right? So this is the real insidious thing with cancer when it gets out of control is your body doesn't necessarily see it as something to kill and it grows unabated and eventually kills the patient. Or can do anyway, obviously. And so one of the approaches, again, and this is highly simplified, but one of the approaches that they have started working on and they're actually getting relatively far with is to figure out exactly what is different in the cancer cell from the underlying patient's normal cell, quote unquote normal cell.
Right.
And then code your killer T cells or other immune cells to go after just those differences. Now, a cancer cell of the tens of thousands of gene positions within any given cell may only have 10 or 12 that differ from an underlying cell of the organism.
Which obviously makes it amazingly hard.
Amazingly hard for the immune system to kill. So what they will do is biopsy the tumor, biopsy a healthy cell, run the full genetic sequencing of both, identify the 12 small places on the tens of thousands of positions that are different, and then program your killer T cells to only look for those 12 differences.
Yeah.
And then introduce the immune therapy.
And you can't do that without like massive computer work, without AI, without the ability to run test after test after test that is in silico, as opposed to many years of in situ kind of testing.
Yeah, it would take a postdoc their whole career to look for one difference, but that is what the machine excels at, looking for those dozen differences in hours and identifying them.
Which is crazy.
So without the confluence of AI and biotech, you're not curing cancer. And yet we are on the precipice of maybe doing that within the next few years.
And I'm going to give our loyal listeners a bit of a disclaimer here. We normally try to keep these at 15 to 20 minutes, but Garvin and I have this ability to continue to talk. And so there's a lot of things we want to cover. So we're going to keep going on here. I hope you stick with us. So if you're good with that, let's keep chatting here.
And
so
if you're not good with you can just give us a call. We'll chat.
Yes, exactly. So we talked a little bit about biotech. That's not one thing you normally think about from a quote unquote sustainable portfolio. One other area that I think we both agree on is real estate and the built environment and the importance of trying to build greener buildings, more sustainable buildings, more technologically advanced buildings. They're better with water, they're better with emissions, et cetera. What are some of the things that you guys are looking at in that arena? Again, everybody knows solar and batteries and EVs. That stuff is just sort of a given. Let's talk about things that are a little different.
Yeah, and you're right. The built environment, it's what's the economy? It's us, the people, and the stuff we use every day, and the energy we use to run it, and then the structures we live in.
Right.
That's it. That's all it is. And then the interactions between those things. That's the economy, reduced to its simplest form, right? So you have to address the built environment, as you put it correctly, if you think you're going to arrive at an indefinitely sustainable economy. Now, unfortunately, there are scarce few real estate opportunities, especially in the public markets, that if the whole economy, if you like, operated the way that they do, result in an economy that wouldn't succumb to system-level risks. Mm-hmm. They're hard to come by because it is so challenging.
Yep.
And so, sure, you want to look for companies that are using renewable energy. That ideally behind the meter, not buying RECs.
Right, exactly.
Yeah, exactly. Like building renewable energy so that they can function sustainably. Part of that is building efficiency, although I would at some point want to have the conversation on the supply versus the demand part of that debate. Because, for example, when it comes to like the massive AI use of energy or, crypto's huge use of energy, these are heavily criticized for exacerbating the climate crisis, and yet any economy that's going to grow and thrive and be innovative needs more and more and more energy.
Right.
So I would.
And there was an article that came out recently that talked about that, about our energy use going up. A lot of it from data centers.
It has to.
And we're not filling it in fast enough
with renewables.
With renewables, yeah.
Yeah, but I would really want the conversation to focus on the supply side.
Right.
As long as we have indefinite true renewables scaling up, the demand side doesn't even matter. Use it for whatever you want. Use it for crypto. Use it for AI. It doesn't matter. The supply side has to be fixed, and then we can use all the energy we want.
Makes a lot of sense.
Yeah. So while coming back to real estate, while building efficiency is very important, especially now while the grid's still pretty dirty, ultimately it's not the very first thing that we look for, although we do think it's key. And by the way, don't imagine that there's not a confluence with biotech here. Because again, advanced materials are largely going to be coming from biotech in the next decade.
Yeah.
And so this is interesting. There are companies like Ginkgo Bioworks that are doing non-medical applications and partnering with institutions to help them, or other entities, organizations, to help them find interesting solutions to problems that they're facing. Everything from, doing like effluent tests of airports so that they can predict pandemic spread to a company, which is just smart, right?
Isn't it? Yeah.
Yeah. To something like an advanced materials or building materials construction firm to help them find better, lighter, more durable, more energy efficient materials as opposed to the old cement or the old drywall, whatever.
Which that leads me into a topic that I think it marries really, really well with what we do, and that's resilience. Climate change. That climate change train has left the station. We're not going to change that. Can we impact it? Yes, we can by using Next Economy. But at the same time, we also have to be prepared for the impacts. And so investing in resilience is another really important aspect.
Yeah, unfortunately, we saw that 2023 was above 1.5 C, above pre-industrial temperatures for the whole year. And it's funny because IPCC won't recognize that because written in their document is it has to be a 30-year trend. So before they will declare that we've officially breached 1.5, it has to be 30 years. But it's funny, if you look at the...
I'm sorry.
I know. But so if you look at the record, if you scroll back through news, I was recently using Gemini Advanced to do this. Gemini, which is Google's chatbot.
Yeah.
I said, when did the news, as far as you can tell, Gemini, when did the news first say that we breached 1.5? And they said it was like 5 years ago for a 1 week duration. Mm-hmm. Okay. When was the first time it breached a month? Oh, about 3 years ago. When was the first time it breached a year? Last year. So we keep moving the threshold for how long.
Would you call that a trend?
Do you think?
I think so.
And so far, January and February of 24, it's also breached 1.5. So what you've got right now is a 14-month streak of having breached. And so, nevertheless, though, I don't want anybody to think I think that the ship has just sailed and we're screwed on that. I think we need to keep our eye on 1.5.
Right.
Because if we shift to 2 now, which maybe realistically we could think about, but we'll just move all of our emission scenarios and all of our transition planning to EVs and to renewable grid, we'll just shift those all to focus on 2. We need to keep them focused on 1.5.
And this makes me think of, there's so many of the big legacy economy companies out there that are saying, we're going to transition our business by 2050. 2050 is 26 years out, and we're already at 1.5.
Mm-hmm. For 14 months rolling.
Yeah.
And so then, what's next? We're going to have the next threshold when, this is the first 2-year period that's eclipsed that. And now we have the first decade.
Yeah.
Well, okay, when do we just say, okay, we're there? How long does it have to be before everybody agrees we've eclipsed that?
And the scary part is you don't want to be alarmist.
Right.
We can't be alarmist because of what you just said. We need to continue to work on improving things. We need to continue to work on creating that next economy because there is light at the end of that tunnel.
Yeah. Oh, absolutely there is.
Yeah.
And this is why I argue that even though we may have, we've demonstrably breached it now, we have to keep our eye right on 1.5 because even though we've exceeded it, what we have to do now is get back down to it.
Right.
So we can't just say that ship has sailed and forget it. We have to keep our eye on it and work towards it, even though we may have breached it.
I'm going to transition a little bit here because we can continue on this track for a while.
We didn't really finish real estate, unfortunately.
We didn't. That's all right. But I think we got the gist on it in general.
I had a whole bunch of stuff about urban infill and brownfielding. All right.
Let's move on. We had a discussion before we started recording earlier, and I think we touched on it just a little bit in episode 1, but just talking about how hard it is to deal with the institutional investors' obsession with indexes, with tracking error, and how, moving forward into the next economy, we need to just trash all that.
Yeah. Where should we start? No. So indexing, Jack Bogle's idea when he founded Vanguard and he essentially, if not invented, popularized the index fund, was wise in a less rapidly evolving economy, which it was at that time, and at a time before the climate crisis anyone was aware of it, with the possible exception of a few Exxon scientists.
Right. And that's a topic we'll set aside for now.
Yeah, let's leave that one aside for a minute. And his idea was democratize investing by making it cheap. Mm-hmm. How do you make it cheap? Well, take the active management out of it, make it brainless. Just use an index that's been compiled anyway by some big organization like MSCI. Oh, they've identified the 500 largest stocks that trade in the U.S. Great. Let's just do a market cap weighted version of that effectively needs no manager, kind of, but only just to balance to those weights. Yep. And therefore we can offer it for a very low number of basis points, democratize it to everyone, and everyone just gets to invest in the economy. Yep. And his famous saying, why look for the needle when you can just buy the haystack? There was wisdom in that. Yeah. Okay, good as far as it went. It relied heavily on Markowitz's theory, modern portfolio theory, written in 1953. More than 70 years ago now. Yeah. Again, when the economy was slower to evolve and the climate crisis and resource degradation crises and whatever else, the poly crisis was not yet upon us. Made sense in their time, right? But they became the inherited paradigm, almost to the point of religion.
I would argue that it probably is a form of religion at this point.
It feels like it.
Yeah, it does.
Talking to many of its strongest defenders or adherents, it does sound like and feel like religion. Yeah. Like they're not willing to consider anything else sometimes. Many are, not all. As though you're challenging a dogma as opposed to an economic theory.
Exactly.
So it's very interesting. So this emphasis on low tracking error versus the old economy, again, as reflected by a major benchmark index, which we talked about earlier, is just very slow to evolve. Right. Not never, but slow. And the idea that the economy of 10 years is just going to be a very linear extrapolation of the economy today or of 10 years ago, that may have been true in 1953 when that book was written, but it is no longer true. Between AI and biotech and the renewable energy revolution and a dozen other things we could talk about, it's very plain now that the economy 10 years hence is not going to look an awful lot like the economy of 10 years ago. And so this insistence that you need to have low tracking error with your benchmark over the last 5-10 years and therefore basically look exactly like it, its time should have come and gone by now. Right. Everything, the risks and the innovation and the economic trajectories are all accelerating so fast that making the assumption that the future is going to be a very simple linear extrapolation of the past just no longer obtains, and we have to give up on that. Yeah. What does that mean in portfolio construction terms? You have to have high active share. You have to not care if you're uncorrelated. And you just have to focus on the most high quality stocks you can find, doing the most interesting work you can find, and then trust that those, and in some cases you can very easily demonstrate it actually, are going to grow faster than underlying GDP and therefore give you every shot at competitive performance over time, albeit in an uncorrelated way.
Over time is the important part. So like I said earlier, it's that difference between short-term speculation and long-term investing in businesses.
You're talking about investing versus trading.
Yeah,
not
exactly.
The same thing.
Exactly. Not at all. Not at all. Future of our business.
Of our business, asset management?
Business, of sustainable asset management.
Okay.
You know, there's at the time that we're recording this, the SEC just came out with some regulations on greenhouse gas emissions transparency. Within like a week or so, it was already, I think there's a stay on it at this point. Beyond that, where are we going?
Interesting about the SEC's reg, right? It was in process for so long, and for a minute it looked like it might actually have some teeth, and then it got so watered down as to not really be that interesting. Even at its very uninteresting final draft, quote-unquote final draft, it still got why it's on hold, as you just pointed out. It got sued by, 17 state AGs?
Something like that. 16, I think,
to put a stop to it, and they succeeded, even though it was like hopelessly watered down anyway. Yeah. In what way? A company had to agree that disclosing its emissions, scopes 1 and 2, 3 was left off the table, was material to their business. So if a given CFO says, well, that's not material to us, they didn't have to do it anyway. So I'm not sure what the 16, I mean, I guess they're just signaling. Yeah. Because there was really nothing, there was no there anyway. But so what that means is, for us, to actually answer your question, is we can't rely on the regulatory framework. There's not going to be a FASB or a GAP for sustainability metrics.
Right.
There just isn't. And even when they make a half-hearted attempt at it, like the recent SEC rule, it gets sued out of existence anyway. So this is why, at the present time, we do need active managers to
Agreed.
go looking for the companies that are making a difference, that are innovating quickly, that are growing faster than underlying GDP, that are good custodians of capital, that do have solid fundamentals, that are going to grow rapidly into the future, provide good returns, and diffuse the systemic risks facing the economy, which, P.S., limits portfolio risk as well.
Right.
So it's as much risk mitigation as it is a growth strategy. So it really is both and. Institutions should be falling all over themselves to get in front of it because it's the most viable long-term way to grow your wealth.
And at the same time, we're dealing with others in our industry that are okay having Exxon in their portfolios.
Yeah.
And so there's this disconnect between, I don't want to call purists versus non-purists, but those are willing to accept the fallacy that owning Exxon and voting your proxy is going to make a change versus actually investing in the solutions providers. And that's about communication. That's about where, you guys and us and other firms that are really focused on solutions-based portfolios need to show that distinction between the two.
Yeah, that's right. And it's not only what you own, but what you don't.
Right.
So every dollar that you put into a next economy company is a dollar that's not flowing into a legacy economy company, and at worst, a destructive company. So this is important because you're right to say that a great number of very well-meaning investors think that owning Exxon and voting the proxies is a valuable lever for change. Newsflash, it isn't. You can vote your proxies at Exxon all you want, and they're going to continue their rapacious ways. The one thing that C-suite and board of directors will understand is a decline in their market cap.
Yep.
So depriving them of the capital flowing into those shares and therefore eroding their market cap is the one signal, speaking of communication, that is communication.
That is communication.
They will understand that they need to start pivoting their business towards something a little bit more interesting in terms of its ability to thrive over the long term. Other than eroding their market cap, I can't think of a stronger signal to send to them.
Yeah.
Meaning, just people who say divesting won't work because somebody else will just buy the shares, you're wrong. Every dollar that doesn't flow that way undermines their market cap and sends the signal that they need to change.
Right.
And in my opinion, that's the only way to do it. You can write all the polite letters you want; they don't care.
They don't care. They ultimately don't care. We're going to wrap up.
Cool.
Everybody gets the same last question. And so Ed Begley got the same, actually, he was the first person to get the same last question.
He was the first.
Yeah. So, in light of everything that we see that's happening around us, you talked about us hitting 1.5 degrees. We've, last year we had hurricane hitting Southern California. We've had fire. Everything is just starting to change. What gives you hope?
Two things. One, the incredible pace of innovation and how fast it's accelerating. People will talk about how change is happening too fast right now, like it's hard to keep up, and it is.
Right.
We have very linear brains. We evolved on the savannah where things didn't change very fast.
Right.
So it's hard for us to think in exponential terms, and yet we need to try. And if we can't do it with our actual own apperceptive machinery, we've got to use tools that can help us do it, right? That's what we're good at.
Right.
So the pace of innovation, so as fast as things are changing now, this is probably as slowly as they'll ever be changing again for the rest of our lives. So look out.
That's a really good point.
Right?
Yes.
So this gives me hope. Like, innovation is accelerating so fast, it may just overwhelm the political obstinacy and the dominant narratives that we need to remain engaged with fossil fuels, among other things. Right? So that's one. And second is that there is a whole cohort of Gen Z that just isn't having it.
Right.
I met with a very bright young student at CU this morning who's working on a campaign to get the Board of Regents of CU to divest from fossil fuels. I told her that is a very, very tough uphill battle, which she understood very clearly. Mm-hmm. She did not care. She was like, I don't care if it is impossible. I'm going to keep trying. And I loved that. So
that's good to hear.
Right?
Yeah.
So that's the other thing that gives me some hope is there's a whole, I'm sure that there are some Gen Zs who still love their fossil fuels, but not that many.
No.
And this particular individual, which I think she's relatively representative of a decent cohort of Gen Z, they're just not having it. They don't care if they're told it's impossible. They're going to push anyway, and I love that.
Yeah, I love that as well. Garvin, thank you so much.
Pete, so much fun.
And I know we ran long today. I apologize for it, but I hope that it was worth it. I want to remind everybody to make sure you like the episode, make sure you follow us on social media, and we will see you next time. Take care.